Good morning, everybody, and welcome to today's webinar. I can see the number of attendees climbing nicely, and it's great to see so many people registered for this event and hopefully getting towards sort of 200 to 300 participants on today's webinar. So that's great, and thank you for joining us. I think the number of participants, the number of registrations really sort of affirms what we've found in our conversations with clients and contacts, which is at a sort of big picture level, inheritance tax planning and worries are very much front of mind with our clients. And it's really for that reason that we've set up the Family Matters campaign, which is intended to be a 12-month focus on various different facets of inheritance tax planning. So far, we've had a sort of general introduction to inheritance tax. We've spent the first quarter of the campaign focusing on business relief because that's the first significant change in the world of IHT. And then from here, we're going to move on to, in the autumn, having a focus on the pension changes, which are very popular, or perhaps not popular, but popular conversationally wise with our clients. And in between that, we're going to look at maybe some of the less technical elements of IHT planning, such as managing the risk of divorce and how to deal with transferring wealth around the family without falling into some of the traps we see there. So we look forward to seeing you on future webinars. But in terms of today, as I said, the focus will be on business relief, and I'm very pleased to be joined by my colleagues. Jamie, who is a tax director based in Leeds. We've got Zoe Davis, who heads up our private client tax team based in London. And we've got Adam Cooper, who is the head of our tax valuations team based in Manchester, but covers all of the UK. And you can see there the agenda. I'm not going to walk through it because we'll quickly get into all of the detail, but just a little bit of housekeeping before I hand over to Zoe. Firstly, we've had a number of questions through in anticipation of the webinar, so thank you to those who've submitted those. Please do add more into the questions box, and we will try to answer as many as possible on the webinar. If we don't answer it live today, we will come back to you. Outside of that, this is being recorded, so a recording will be circulated round if you want to rewatch any of it, or if you want to forward it on to anybody else that you think it might be of interest to. And lastly, do feel free to get in touch with us directly. Our contact details are all on one of the latter slides, and we're very happy for you just to ping us messages or give us a call to talk things over. So I think that's all from me, and I'm now going to pass over to Zoe to kick us off. So over to you, Zoe.
Thank you, Nick. And good morning, everybody. Welcome to the webinar. So let's get going then. So let's set the scene for business relief changes and where are we? So where were we is probably the more important question at this point, which is where we were is that we used to have an unlimited amount of business property relief that would shelter 100% of the value of qualifying assets from IHT. So it didn't matter whether our business was worth £1 million, £10 million, 100 million, 500 million, didn't matter. We could have unlimited relief. And that had been the case for quite a long time until April. So that full relief is now capped at 2.5 million per individual or 5 million per couple. And you can transfer between spouses and civil partners. After that, so after that 2.5 million per person, you drop that relief from 100% down to 50%. So effectively what that means is we've almost got a 20% tax charge, so 50% of the 40% IHT rate applied to any value of the business that's over that 2.5 million per individual. So to talk you through what that looks like, for a real life example, imagine we've got a £30 million business owned by a couple who both own that equally. We've got 5 million between them that qualifies for full 100% relief from inheritance tax. And then the remaining 25 million only gets 50% relief. So effectively that 20% charge. So what we've therefore got is a £5 million tax bill for inheritance tax on this £30 million business, where previously it would have been zero. it's not just an absolute tax charge we're talking about here, it's also cash flow. So that IHT bill, when it arises, falls on the estate, but the money to pay it might not exist in cash somewhere. It's often tied up in a company, in a business. So how do you then pay that? And you've got to think about what do you need to pull out perhaps from the company and when, which usually will trigger a tax bill in its own right. So that rate of tax of 20% effectively of IHT that you're paying on any value over 2.5 million each. We've then got to think about how we fund it, which could actually add to that tax bill. So moving on, really important to understand how you qualify. The relief is nowhere near as valuable as it was, as we can see. We've just talked that through, but it's still really important to understand whether you qualify or not, because 2.5 million or 5 million per couple is still a large amount of money to shelter from IHT at 40%. So what do you need? You need a trading business, which could be a sole trader or a partnership, and that can qualify for 100% up to now the 2.5 million cap. It can be shares in an unlisted trading company. Again, that can attract 100% relief up to the cap. Some AIM shares will be included, but they will get 50% relief. If you've got a controlling shareholding in a quoted company, that can attract relief, but only 50% as opposed to 100%. And any personally owned assets that are used in the business, they can also qualify, things like land or machinery. That's the usual ones that we see, but again, a 50% relief. The other conditions we need to satisfy is a holding condition. So you need to have held it for at least 2 years. And it can't be in liquidation. But the biggest one, and the one that I see that catches people out, is you cannot have a binding contract for sale. It does not qualify. Effectively, you're not inheriting shares, you're inheriting pretty much cash at that point because they're about to be sold and converted into cash. And the way you see this manifesting is normally in a shareholder agreement or something similar, where someone is required to buy those shares. That scuppers your relief. So really important, there's only an option to buy or sell. That one can catch everybody out. So please watch for that. Also important to watch for accepted assets. So they are assets held within the business or held within the company or group that are not used wholly or mainly for the purposes of the trade. And examples of that might be, think of examples I've seen, a helicopter, in the group that isn't for the purposes of the trade. That's personal for the shareholders. Or one that's quite common is seeing investments effectively sitting in, they've been accumulated, money's been made within the business, and then they've been parked in an account, tied up effectively for investment purposes, but not for future use of the trade. That's a really important one to understand what things have been earmarked for. And this one again can catch you out. Important to understand what's that fund, if anything. Is it just investment, or has it been earmarked for the business and for the trade? If the latter, make sure that is documented and regularly reviewed to make sure you don't get caught out by this one as well. So they're the conditions that you need to make sure that you would meet if you want to qualify. And if you do qualify, if we move on, then we've got that 2.5 million or that 5 million. Now, before, because we had unlimited relief, we quite honestly just didn't really care if that business was worth 1 million, 5, 10, 100, the example I used earlier. We didn't mind, when we're looking at things for clients, if it's all exempt, it's all exempt. It doesn't matter what the number is. So when we're looking at inheritance tax planning, quite frankly, it wasn't really important. What was important is whether you qualified and how to make sure that you did. Now it's crucial because we need to understand what sits over that 2.5 million or that 5 million for a couple, and therefore what the excess is going to be taxed at. That 50% of the IHT, so the excess is going to be taxed at 20%. We need to know what that number is to understand what our exposure is going to be. But it's not just us and clients and business owners that are worried now about what is that valuation, understanding their exposure. HMRC also care. So previously, they, again, similar to us, weren't really interested because if it was fully qualifying, it's fully relievable, it's not really so important for those purposes. But going forward, IHT valuations are going to be required. And Adam, you were going to talk us through that in a little bit more detail.
Thanks, Zoe. Yes, so I'm going to talk about how HMRC approaches valuation. So I think it's worth noting that they have a large team of specialist valuers in their shares and assets valuation division. I think it's over 100 now. But they've said that their caseload is already increasing and that they're recruiting and training a lot more staff. So we can't assume that there won't be lots of inquiries into values reported on IHT and trust returns due to lack of resource. So some of the key valuation principles. So any tax charge is calculated based on the market value of the assets. And market value is the best price which the property might reasonably be expected to fetch if sold in the open market. And there's over 100 years of case law which helps frame this definition. So a handful of some of those key concepts. So first of all, the sale is assumed to be between hypothetical anonymous parties. It's not the price that the actual holder would sell to the actual recipient. The only identifiable characteristic of the seller is that they have ownership of those shares. We can't assume anything else about them. Now, this can be really important because it means that any rights or restrictions that aren't contained within, say, a company's articles of association and therefore applicable to any shareholder are completely ignored. So that includes any side agreements, any contracts or shareholder agreements just aren't relevant for valuation. The second is that any transfer restrictions are suspended for the purpose of hypothesizing this notional sale. So you'll often have in family-owned companies is restrictions on who the shares can be sold to. So maybe just to certain family members. So I often have clients telling me, well, surely these shares can't have any significant value because they can only be sold to a select few individuals. However, the case laws establish that market value represents the price someone would pay to stand in the shoes of the shareholder and only then be subject to those restrictions. And thirdly, there's the concept of the information standard. So this governs what information is admissible to the valuation. So it says that only information that could be reasonably required as a condition of purchasing the shares would be provided to the buyer for the purposes of formulating their bid. So depending on the size and value of the shareholding, this could mean that it's only publicly available information which should be used in the valuation. So this can lead to lower valuations than would otherwise be the case. There's a lot of technicalities there, but I think the key takeaway really is that valuations for tax purposes can be very different to those prepared for other purposes, such as commercial or accounting. Sometimes that works against the taxpayer, but often, and I'd say probably more commonly, it works in their favour. So next, I'll talk about briefly how you value a business. So generally speaking, a market approach should be used to value a trading business for tax purposes. So the key steps in this approach are you select an appropriate financial metric for the company. So usually that's a measure of earnings, such as EBITDA or profit after tax. And then you make any adjustments to calculate a normalized or maintainable level of earnings. You then identify comparable listed companies or comparable transactions involving private companies for which price information is available. So these are companies that operate in the same sector or have similar characteristics to the subject company. You then calculate their implied valuation multiples, so their EV/EBITDA or multiples or their price earnings multiples. In an ideal world, the comparators are identical to the subject company and you can just use their multiples. But in reality, there will be differences, often substantial differences. So you need to make subjective assessment of what an appropriate multiple should be for the subject company, taking into consideration differences in size and scale, diversity of operations, geography, growth prospects, and various other factors. Usually, the selected multiple will be lower than the multiples of larger and diverse listed businesses, but the key part of the valuation exercise is how you determine how much lower it should be. So HMRC will not accept arbitrary discounts to comparative valuation multiples. It needs to be supported. Once you've got the multiple, you apply it to the selected financial metric to get a value for the subject company. If you've used profit after tax or profit before tax, it will give you an equity value. So that's the value of all of the shares in the company. However, if you've used EBITDA or indeed any measure of earnings pre-interest expense, it will give you an enterprise value. That's the value of the business's operations before taking into account its capital structure or any debt financing. So once we have enterprise value, we then need to make adjustments for any debt, surplus cash, a normalized level of working capital, and any other non-operating assets or liabilities to calculate equity value. And those adjustments can be quite important because they feed into the point Zoe was making earlier around accepted assets. So once you have an equity value for the company, you then need to calculate the value of the relevant shareholding in the company. So if the company has a single class of shares, this is straightforward. You just take the equity value and you divide by the total number of shares. But if there's multiple classes of shares with different rights, it can get much more complicated. And this is where I see a lot of issues with valuations. So if there's A, B, C class shares, if there's preference shares, things like that, we need to think about how each of those share classes should be valued individually. That's beyond the scope of this webinar, but we will touch on growth shares later. So what we will cover is minority discounts, and these can substantially reduce the amount of tax payable. So if you just flip on to the next slide. So the general principle is that the per share value of a control holding is higher than the per share value of a minority holding. So that's because as a controlling shareholder, you can appoint directors and you can pass ordinary and special resolutions. You therefore control the strategic direction of the business and have access to its cash flows. You can also sell your shareholding more easily, particularly if there are drag-along provisions in the company's articles of association, which enable you to require minority shareholders to sell their shares too. It's much easier to sell a whole company than it is a shareholding within a company, particularly if it's a minority. The inverse of this is therefore a minority discount, though it can apply to majority shareholdings too, particularly if they're below the 75% threshold required to pass a special resolution. So a more appropriate description is generally a discount for lack of control or a discount for lack of marketability. These are the two key concepts which depress value. One thing to watch out for is the aggregation rules in place for inheritance tax. So in valuing a shareholding, you aggregate the shares held by spouses or civil partners. So if the husband holds 40% of the shares and the wife holds 40% of the shares, you would value each shareholding as half of an 80% shareholding rather than two individual 40% shareholdings. So that impacts the appropriate level of minority discount. Also worth noting that those rules don't apply for capital gains tax. Often you'll get differences in value for inheritance tax and capital gains tax because they need to be quantified using different methods. So how do you quantify minority discount? Well, many years ago, HMRC had guidance in its valuation manual on typical discounts for different size shareholdings in different types of companies. But what they found is that taxpayers applied those discounts without giving any thought to the factors which actually influence the level of discount. So HMRC withdrew that guidance. This was 15 plus years ago now. And they've said on many occasions since that they will not accept justification for discounts based purely on this historical guidance, and that discounts should be determined on a case-by-case basis. So as what used to be in their manual, and which still appears on lots of different websites, can be a helpful guide, taxpayers are going to need to justify whatever discount is applied. So if we can't rely on HMRC guidance, what factors influence an appropriate discount and how do we quantify it? So on the right-hand side of this slide, I've set out a non-exhaustive list of factors that influence the discount. I won't go through all of these, but some of the key considerations are the size and influence of the shareholding, by which I mean the proportion of votes that it confers. So an appropriate discount drops as you exceed 25% of the votes, because you can then block a special resolution, and then drops further as you pass 50%, because you can pass ordinary resolutions and often appoint and remove directors. Another key consideration is the expected period until a liquidity event. So if the majority shareholder is actively exploring opportunities to sell, and as a minority shareholder, you would have the opportunity to piggyback on that transaction and sell your shares too, the discount would be lower than if the intention is that that company will continue to be family owned. A sale would mean you're no longer locked into an investment and you have an opportunity to turn your shares into cash. And the final one I'll touch on is dividend policy. So if the company is paying regular dividends on the minority shareholding, the ability to sell your shares or influence company policy will be less important because you're already receiving cash returns through other means. Historically, the key sources of data for quantifying minority discounts was case law. You would find cases with comparable fact patterns and use the discounts from those cases. But more recently, there have been various empirical studies on discounts for lack of marketability and control. These are restricted stock studies and there's control premium studies. There's also various mathematical models that have been developed to quantify discounts for lack of marketability. I won't go into each of these, but the key point is that whatever discount is selected, it needs to be supported by data and reflect the factors on the right-hand side of the slide. So now we've talked about how you might calculate potential IHT liabilities. Jamie will talk you through some of the planning strategies and solutions.
Thanks, Adam. Yes, great. So as Adam said, we've covered what the problem is. We've covered how that problem might be quantified. What I'm going to talk to you about now is how we've seen families responding to this. In other words, what are the practical strategies available to them? And as many of you are sort of business owners, you'll appreciate that there isn't a one size fits all solution here. And quite often, the right approach will depend heavily on a family's objectives, the governance of the company, and an appetite for sort of complexity within planning. But what we can do is work through a structured approach and then look at some of those key mitigation strategies in turn. So if we look at our approach to planning, we've already talked about the importance of quantifying that exposure, and that's becoming more and more important now. So firstly, until we've valued the business and modelled what that relief position may look like, it's really difficult to undertake any effective planning. So often our starting position is quantifying what a potential IHT liability looks like. It may be that there is no IHT problem at all, or it may be that we've got a much bigger inheritance tax problem than what we previously thought. So starting off with a solid valuation is where we tend to start things. Next, we want to make sure that we are going to be qualifying for business relief. So as Zoe touched on earlier, the qualifying conditions for business relief, let's make sure that we are within those rules. Have we got a business relief qualifying business? Are there any accepted assets? Do we need to be looking at restructuring the group to maximise relief? So let's make sure that we're ticking all of those. Let's make sure that we're ticking all of those boxes, and we know where we sit. Once we've done all of that, we can then move on to the mitigation strategies, and that's where I'm going to focus the majority of this section, looking at some of the things that we're talking to our clients about and that we've been implementing for clients, particularly since the rules changed. Alongside that, we need to make sure that the legal framework that sits around this planning aligns with that tax planning strategy. So for business owners, that quite often includes wills, articles of association, shareholders agreement. It's great as undertaking all of this planning, but if ultimately the legals don't reflect the planning that we've undertaken, then it all can fall down. So let's make sure that we're joined up with the lawyers and make sure that the tax planning not only aligns with a business owner's objectives, but also the tax strategy and the legal framework that's going to sit around that. And then finally, even after we've undertaken all of that planning, there can still be some residual exposure. So we need to think about how that exposure is going to be funded. Liquidity is, I guess, the second most important thing to think about after the headline tax number. Are there other assets within the estate that can fund that inheritance tax liability? Is the business itself going to be expected to fund the liability? Could it look to buy back the shares, or could it look to pay the inheritance tax liability over a number of years? We'll touch on that shortly. But again, that can put significant stress on the business. So have we stress tested the business? Are we aware that the company can afford that, or is that going to put undue pressure on the business from a trading perspective? And then finally, insurance. So insurance has always been there and has always been an option. But I think we're seeing that more and more, and Nick's going to touch on that later, of how insurance can feed into those mitigation strategies. Okay, so what I'll do now is just dive a little bit deeper into some of the key topics that we're talking to our clients about. And I'm going to start with direct gifting, because this, I think, is probably one of the simplest mitigation strategies that we're seeing. But it cannot be sort of underestimated, and there's more that goes into it than just giving everything away. So from a tax perspective, how does it work? We talked about the £2.5 million cap earlier on. Currently, there is no cap on direct gifting, so you can give away as many shares as you like and as great a value as you like, and there is no immediate inheritance tax liability for that. There has been talk in the run-up to previous budgets. Would the revenue cap that and have some sort of lifetime limit? Would they increase the period after which you need to survive the gift before it falls back into your estate? So currently, you make a gift, you survive for 7 years, and that gift has fallen outside of your estate for inheritance tax purposes. So for business owners that are in good health, that are expected to survive that 7 years, direct gifting can be a good strategy. It also works particularly well if the next generation are involved in the business or are keen to be involved in the business and want to drive that forward. Can create a problem if children or next generation or future generations don't have an interest in the business, and actually, is it right, therefore, that we are putting value and putting valuable shares into their estate? As well, we need to consider the children's inheritance tax position or the next generation's inheritance tax position. It's okay moving shares out of one estate, but are we just kicking the can down the road and creating a problem for the next generation? I talked about inheritance tax and surviving the 7 years. We also need to be really cognizant of capital gains tax. So giving shares away is treated as a disposal for capital gains tax purposes. Now, there is a relief available that can exempt that and almost pass the capital gains tax liability on to the next generation or the recipient of the gift. The tests for that relief are a little more onerous than the business relief conditions. I'm not going to dive into those today, but we just need to make sure that those conditions are met and we are not inadvertently triggering an unexpected capital gains tax bill. The other point to note is that when shares pass on death and they are assessed for inheritance tax purposes, whether or not there is any inheritance tax payable, for example, if business relief is available, they are rebased for capital gains tax purposes. So if the shares were worth £10 million and they're assessed at that value for inheritance tax purposes, in the hands of the recipient, they've got a base cost of £10 million for capital gains tax purposes. So if they were to sell the shares shortly afterwards, there'd be no capital gains tax payable on that. So we need to be really mindful of that when we are giving shares away. Yes, we can be moving value outside of the estate for inheritance tax purposes, but we're going to lose out on that uplift on death for CGT purposes. So again, that's not to say that direct gifting doesn't work. We just need to take into account all factors. And actually, if the next generation are just going to sell the business, then we need to think carefully about whether a gift is the right thing. And we'll see in here, we've got an example. So we've got business owner parents gift their £10 million company to their daughter. After their death, the daughter finds running the business difficult and decides to sell. Now, as we've mentioned, because the shares carry the founder parents base cost, there's limited base cost for capital gains tax purposes. So the daughter has a CGT liability of £2.4 million. We've not touched on business asset disposal relief, previously entrepreneurs relief, but if the daughter's not held the shares for long, then that relief may not be available anyway. However, the sort of converse of that is if the parents had left the shares to the daughter on death, yes, we would have suffered an inheritance tax liability of £1 million, but we would have avoided that capital gains tax liability. So again, just be mindful that gifting is not always the right answer. We also need to be mindful of loss of control. So from a business continuity perspective, is it right that at shareholder level, we are passing shares away to the next generation? What if the next generation are not interested in the business, are in an unsettled relationship, are potentially in a vulnerable situation? All of those sort of disaster scenarios that we don't like to think about, bankruptcy, divorce, etc. So we just need to be mindful that, yes, tax is very important, and it might sound odd for a tax professional to be saying this, but we just need to be mindful of all of the other non-tax considerations as well. And then finally, if gifts are made, we just need to think about the reporting as well. So whilst there may be no tax payable on the gift itself, it may still need reporting on tax returns, and making sure that those CGT elections are done and it's properly reported to HMRC. So again, we can't forget about the principles. I think Adam's just also going to talk about now about the impact of minority discounting and bringing that to life in another example.
Thanks, Jamie. So yeah, I framed minority discounting as a good way of reducing IHT liabilities on death, but actually it oddly can work against you for direct gifting. And that's because when we are assessing IHT liabilities, we're using the loss to donor principle. So what we're not doing is looking at what's the value of what has actually been transferred. We're looking at what's the reduction in the value of the giftor's estate. So there's an example here to kind of bring that to life a little bit. So we've got a family business where the father owns 60% of the shares, the daughter owns 20%, and the son owns 20%. So as part of the father's succession planning strategy, he decides to give 20% of his overall shares to his daughter, reducing his shareholding from 60% to 40%. So if we say that those shares are worth, say, 200, in my example, you'd apply a minority discount to that. Let's just say it's 50%. That would give a value for those shares of 100. However, when we're looking at it from an IHT perspective, what we actually need to do is value the father's shareholding beforehand, which was the 60%, and then the father's shareholding afterwards, which is the 40%. So a 60% would attract, in my example, a 20% discount, and the 400 shareholding in my example would attract a much larger 50% discount. The reason being, the 60% shareholding has control. You can pass ordinary resolutions, you can appoint directors, you can remove directors, whereas you can't with a 40% shareholding. And if you look at the reduction in the value of his estate, it's actually reduced by 280. So by gifting shares that were worth 200 on a pro rata basis, or potentially 100 on a discounted basis, actually the potential IHT exposure here would be 280, so substantially higher.
Thanks, Adam. So moving on to our next mitigation strategy, and trust. And trust play a really important part in planning for clients. We've talked about direct gifting and some of the benefits of direct gifting, but also the wider considerations. And quite often those wider considerations are around sort of that control element and that protection element. So trusts are great from a tax perspective, but also from an asset protection perspective. So trust often play a really important part in any mitigation strategy. So again, people can make a gift of assets onto a trust, and that allows them to retain a certain level of control as during their lifetime, they can act as trustees. So whilst they are unable to benefit from the trust themselves, future generations, so children, grandchildren, great-grandchildren, can all benefit from that trust. So it's really important to make sure that the donor isn't giving away too much value. Again, being mindful that they can't benefit from any gift into that trust. But survive 7 years, and that gift again is outside of the estate for inheritance tax purposes. Now, we do have a restriction on the value that can be transferred into a trust before triggering an immediate inheritance tax charge. So unlike with the direct gifting where it's unlimited, with a trust there are some limits that we need to be mindful of. So individuals can gift up to £2.5 million of business relief or agricultural relief qualifying assets onto trust every 7 years before triggering an inheritance tax charge. So you could transfer more than that, but we would have an immediate inheritance tax charge at that point. So quite often we try where possible to stagger that planning and make sure that we're not triggering the immediate inheritance tax charge. And that really is one of the key reasons why it's better to start having these conversations sooner rather than later, and not leaving it to sort of later in life when it's potentially more difficult to make these gifts. It's also important to remember that trusts are not inheritance tax free. So trusts have their own inheritance tax regime, so slightly different to those for individuals. But trusts are assessed on inheritance tax every 10 years. And the value of that inheritance tax charge is up to 6% of the value of the assets within that trust. That can be reduced to 3% where the shares or the assets in there qualify for business relief. So again, we just need to be mindful, and the trustees, and we often work with trustees to plan for any ongoing inheritance tax charges. How are those going to be funded? Often by way of dividends. Does the company have sort of sufficient means to fund those inheritance tax liabilities by the trust? So again, it's just bringing all of that planning together and making sure that that the trustees are aware of their sort of tax obligations on an ongoing basis. We also need to be careful where we're making gifts. So quite often we'll make direct gifts and gifts onto trust. There are some funny rules around the ordering of gifts. So it's really important that we consider, do we make the direct gifts first before making gifts onto trust, or vice versa? So again, care needs to be taken here just to map that out to make sure that we don't come unstuck of any of the inheritance tax rules there. And finally, the reporting requirements. So again, we can gift assets onto trust up to that £2.5 million. So we're not triggering an inheritance tax liability, but we just need to be mindful that those are properly reported on individuals' tax returns. Inheritance tax returns are completed, capital gains tax elections are made, and everything is filed correctly with HMRC. So again, we can help make sure that all of the planning is undertaken sort of correctly and also reported correctly to HMRC. As Adam touched on earlier, the revenue didn't used to be so bothered about the value. I think going forward, we're going to see a lot more scrutiny of the values that are applied to those forms. So again, making sure that a robust valuation has been undertaken and is correctly reported to HMRC is going to be more and more important. I've included an example in here, which is a typical example really of what we're seeing and what we're talking to clients about. So family business that's valued at £20 million. Historically, the parents may have kept hold of the shares until death. They'd have been rebased at death for capital gains tax purposes, and then children could have inherited those shares, or trusts could have inherited those shares with a rebased value for capital gains tax purposes. As we've talked about now, the parents may look to accelerate some of that gifting. So two parents, each gifting £2.5 million onto trust, and also making some direct gifts to the children who are involved in the business. So we're moving £10 million outside of the estate of the parents, and a potential saving there for inheritance tax purposes, provided that they survive for 7 years. However, the parents have still retained £10 million of shares. So what are their options for that £10 million of shares? Firstly, we could wait. If parents are in good health and no sort of underlying health conditions, they may be happy waiting 7 years, waiting for those sort of allowances to reset and making further gifts into trust. We could also look at growth shares, which we're going to touch on in a moment, as a means of almost capping that inheritance tax liability, so that any future growth in value sits outside of their estate for inheritance tax purposes. Or finally, insurance, which is becoming more and more popular, particularly where we've got younger shareholders in good health. It could be a cost-effective way of almost insuring that liability. Or actually, is it a combination of all of the above? And I think actually that tends to be the answer, that when we look at everything holistically and in the round, we pull on all of those different planning levers, and quite often a strategy will involve a combination of direct gifting, gifts onto trust, growth shares, and potentially insurance as well. Okay, so moving on to our next topic, which is growth shares. And I'm going to hand over to Adam, because I will probably do growth shares a disservice. But Adam will talk us through how growth shares can work in our mitigation strategy.
Yeah. Thanks, Jamie. So a growth share is a class of share that's introduced into the company's articles of association, and it would generally be held by, for example, the children, either directly or through a trust. And that growth share has a particular set of rights, which means that it's only entitled to value above a certain threshold or hurdle. So I guess taking Jamie's example from before, we've got a business that is maybe worth 20 million. And the intention, therefore, is to introduce a new class of shares, and the threshold may be set at 20 million, which means that if in the future the value of the business grows, and it may grow to, say, 50 million, all of that growth in value above the 20 million threshold should, if structured correctly, fall within the children's estate instead. So if there's, say, a sale of the family business in a few years' time for 50 million, the children would get the 30 million, and the parents would receive 20 million. So it's capped. The value is capped in their estates, and it's, I think, a really good way of getting value into the estates of children without actually transferring anything to them that has substantial value. Because when growth shares are first introduced into the company's worth 20 million, the threshold is set at 20 million. Yeah, they have very little value at that point in time. Now, I say very little value because growth shares do have some value. And again, this is quite a common error that we sometimes see. We see sometimes advisors telling clients that growth shares have no value at all. And you can kind of understand why. If the business is worth 20 million and the threshold is set at 20 million, if that business was sold today, those growth shares wouldn't get anything at all. But how HMRC approach these valuations is actually to try to look in the future and guess, well, yeah, we might expect the business to continue to grow. And if we think that the business might be sold in a few years' term, what could the growth shares receive in the future? And they discount that back to present value. So growth shares are not a new thing. They're very well established. They're used as a tool to incentivize employees in many trading businesses. They're also very common in family investment companies as well. So we know how HMRC approach these things. But what we're seeing now is that where previously they were just applicable for family investment companies or to incentivize employees, they're now being used more commonly as a succession planning tool.
Thanks, Adam. And then finally, I just wanted to touch on UK residents. So lots of our clients are asking us about moving offshore, particularly to mitigate their inheritance tax position. And in theory, it is possible, but there's lots of things to consider. I think the first one is actually a non-tax point, and it is actually, is moving abroad feasible, and do you actually want to live abroad? I have lots of conversations with clients and prospects who like the idea of not paying UK taxes, but really, when sort of push comes to shove, and actually, could they physically live abroad and be restricted with the number of days that they can spend in the UK? That's quite often where it can fall down, particularly where we've got children and grandchildren still living in the UK who are not able to easily move and relocate. So my starting point is always not for tax reasons, but do you actually want to live abroad? And then secondly to that, where do you want to live? Because it's all sort of well and good leaving the UK, but if we're going to go to a jurisdiction that has more punitive tax charges than the UK, then it may not have met that objective of reducing that tax liability. But provided we can get over that hurdle and somebody does want to leave the UK and they've settled on a destination of choice, from a UK perspective, the rules changed in recent years. So from April 25, we moved away from the concept of domicile, which was sort of largely where you were born, to a new residency-based system. And this concept has been a long-term non-resident. So if you have been outside of the UK for 10 years, then you can be outside of the UK inheritance tax net. So whilst ever you are resident in the UK and you are deemed a long-term resident of the UK, then you are subject to inheritance tax on your worldwide assets. So not just assets in the UK, assets wherever you are in the world. So it's not just a case of sort of popping out of the UK and you're immediately outside of our UK inheritance tax net. You've got to be out there for up to 10 years, depending on how many years you've been in the UK. So we talk about this 10-year tail for inheritance tax purposes. So people need to be mindful that this is sort of long-term planning, and you need to be comfortable that you can be outside of the UK for that long. You also need to be mindful of the inheritance tax implications in the jurisdiction where you are going to relocate. So again, what are the inheritance tax rules in that country? Do they recognise some of the structures that we may have in the UK? So particularly trusts. Lots of countries, lots of European countries, particularly, don't recognise trusts, and they just don't have that trust concept in their laws. So again, care needs to be taken where planning has been undertaken under the UK rules. How's that going to affect you if you are moving offshore? And then I think final point on this again is probably a non-tax point but from a business continuity perspective, is it feasible for you as a business owner to be outside of the UK? It may well be, and lots of businesses now are global, and their owners are internationally mobile. But how's that going to impact your business if you not been in the UK and sort of being restricted with the number of days that you can spend in the UK? So yeah, we mention it here as a strategy. It can be a strategy for some people, and it can work really well. But I think care just needs to be taken to make sure that everything is considered in the round. And there are lots of rules around residence, and it can be quite restrictive in terms of the number of days that you're able to spend in the UK. So just making sure that anybody considering that planning undertakes it with their eyes open and fully aware of those rules. And then finally, on this section, we talked earlier about the practical points that go alongside this. So making sure that the legal documents match the planning that's been undertaken. So particularly wills, for example. Do they reflect, firstly, your wishes, and then secondly, any planning that's been undertaken? I often find that wills are one of those things that people don't like to think about, particularly business owners who are sort of busy, head down, focusing on the business. Quite often they sort of neglect their own planning. So we can help make sure that we're working with the lawyers to make sure that there is an appropriate will in place that reflects a business owner's wishes and also planning that they've undertaken. Secondly, that concept of fairness. So particularly where lifetime gifts have been made, there may be children involved in the business, children not involved in the business. Children involved in the business may have received shares as part of that mitigation strategy. Do we need to do anything to even that up in the will? So perhaps more of the other non-business assets go to children not involved in the business. So again, it's a case-by-case basis, and these are really personal decisions, but just making sure that we're not solely focusing on the tax, and all of this is covered. And the final point I just wanted to touch on wills is around that transferable business relief allowance. So that £2.5 million allowance between spouses and civil partners. So just making sure that we are banking that full £5 million allowance between a married couple. So if shares are not passing in the right order, or are passing out to beneficiaries in the wrong order, then we may be wasting some of that allowance. So just making sure that we have reviewed wills and reviewed plans, and we know exactly where assets are going to pass on death, and make sure that we're fully maximising that relief. Secondly, shareholders' agreements. So Zoe touched on them really early on, and having if there is a binding contract for sale in place. So if a shareholders agreement says that the shares have to be bought back, then that can mean that there's no business relief available at all. So making sure that instead of having a binding contract in there, we've got some put and call options. So actually there's an option to buy the shares and there's an option to sell the shares, but it's not binding. So we're still within the rules for business relief. But then also that shareholders agreement making sure that we're comfortable with where those shares are going to end up. So particularly where we've got sort of non-family shareholders, are we comfortable with where those shares are going to pass on their death? So just making sure that any shareholders agreements reflect that. And then finally, funding. So we've done all of this. We've done all of this great planning. But as we touched on in the earlier example, there may still be an inheritance tax liability after all of that planning. So what plans have we got for paying that inheritance tax liability? So when these new rules were announced, HMRC generously to them said that you can pay this inheritance tax liability, will allow you to pay it over 10 years. So you can pay it in installments over 10 years, interest free. So great on the face of it. However, how is that going to be funded? That's then putting a strain on the business, or an obligation quite often on the business to fund that inheritance tax liability over 10 years. And actually, is that then detracting the business from growth that it may want to do? So how is that going to be funded? Could the business buy back those shares? Does it have the means to buy back the shares from a deceased shareholder and increase the sort of proportion at holding of other shareholders? Does a business or a company have the ability to borrow to fund those options, or is it going to be funded out of sort of working capital over that period? So all of these sort of considerations just need to sort of form part of that mitigation strategy and that plan, that we're not just focusing on what is the tax number, but also how is that tax number, how is that tax going to be funded? And then finally, insurance. So we're seeing lots more clients look into insurance to either kick that can down the road, or as a way of sort of protecting themselves and that business continuity, that actually there's going to be a pot of money there to cover that inheritance tax liability. And yes, that is going to come at a cost, but hopefully that gives some sort of peace of mind that the business can continue, and an insurance policy is going to be there to cover that tax liability. And that's where I'll just hand over now to Nick, who's been sitting patiently waiting to talk about insurance and the different types of insurance policies that can be used.
Thanks, Jamie. Yeah, and a relatively, hopefully, straightforward place to finish here, given the technical detail that Jamie, Zoe, and Adam have given us so far. I think an observation here, exactly as Jamie said, probably an unintended consequence from Rachel Reeves' perspective, that the insurance market seems to be a beneficiary of the proposed IXT changes, both here in lots of business owners seeking additional insurance, but also the pension side, which I know everyone's very interested in. We're getting lots of questions on that, but the annuity markets are really sort of heating up, which is also naturally provided by insurance. So a bit odd who's benefiting from it, but nonetheless, we're seeing a big uptick in insurance inquiries. So conscious that we haven't got very long and I want to give us time for questions, so I'll just canter through these three routes relatively quickly, because there's three different ways in which business owners are looking to the insurance markets to solve this problem of some residual inheritance tax liability. And I guess it's important to state there's a reason this is the last slide, because this insurance question has to be the very last thing you do, really. You can't just jump to right, I'm going to stick in place a £10 million insurance policy, because it's very hard to know what the valuation of the business will be like, what minority discounts might be available in your wider inheritance tax position, etc., etc. So this isn't just a quick fix, but it is something that might help at the end of the process to cover any residual liability. So the three routes really are, as I've described it there, the tax efficient sticking plaster for business owners is something called relevant life cover. And that's effectively just a bog standard term insurance policy that typically runs to 75, can't go beyond that date. And the business owner is able to take that out. The company can pay the premium, so it's nice and tax efficient. And if death occurs before age 75, then a chunk is paid out into trust for the family to then use to meet their needs. And there's a reason I've been careful with how I term that last sentence, because the revenue is quite explicit that relevant life policy shouldn't be used directly for tax planning purposes. So we have to be a bit careful around how we position relevant life policies. However, in my view, it's very hard to differentiate between whether something is direct inheritance tax planning or if you're putting your family in a suitable position should something happen to you and that incurs an inheritance tax liability. So there's a bit of thinking to do there, but ultimately, relevant life insurance can provide a good sticking plaster for those business owners who know that their estate has an underlying inheritance tax liability. And because that policy has a fixed endpoint, i.e., 75 at the end, at the latest, the cost is usually relatively manageable. Naturally, that will depend on health and age and all those sorts of things, but generally, it's a lower cost option than the last one we'll come to. The second, and this is probably the one I've seen the most in the last 12 months, is where business owners have taken that decision to transfer shares that they otherwise would have held till death. There is a big concern that effectively they run the risk of indirectly incurring capital gains tax and inheritance tax, which is a pretty awful tax outcome. I think we can all agree on that. So what they say is, I want to pass off the risk of me dying within that 7-year period by asking an insurer to cover the risk of me dying within that 7-year period. And the way that's structured, because of the taper relief that's available on gifts, is you have one policy that covers years, and that's your highest level of exposure, and then that steps down between years 4 and 7. And here you can see that the cost comes down, and actually the costs of insuring £2 million worth of gifts really isn't that significant. I suppose the key point to note here is this would be a personal policy. Again, you'd most likely write this into trust. And in terms of age profiles, we have placed some cover in the last 12 months for somebody from the age of 79 through to 86. So I guess the message there is it's not too late. I think a lot of people think insurance will become exorbitantly expensive in your 70s. Actually, if you're in decent health, it's worth having a look at. And then the last one, which is much more expensive, so I'll get that warning out now, is the whole of life option. And this is essentially the deal with the insurer that I will pay you the premiums for as long as I might live, and then you will pay me X when I ultimately die. So it's not a case of if you live beyond a certain point, then you've not achieved anything from the insurance product. Ultimately, if you keep paying the premiums, you will get a payout. And therefore, you can sort of look at this more as a return on investment type model. And I've put that down at the bottom there. If you're a 60-year-old individual with a sort of underlying £2 million exposure from your business, if you pay the £2,500 a month and ultimately have to wait until you're 90 to get the 2 millions to pay the IHT liability, if you work out the sort of the internal rate of return on that, it's a little shy of 5% a year based on the premiums you've deployed over that 30-year period. So it's expensive, but it serves a purpose, and it ultimately sort of guarantees that there will be cash available to pay the IHT liability, irrespective of how long you might live. Just a very quick word of warning with 2 minutes to go. With these policies, there's a lot more to it than just putting an insurance policy in place. You've got to get the trust provisions right. You've got to be very careful around, is the payment of premiums a chargeable lifetime transfer? If it is, you have to be very careful about the order in which you're doing things, going back to something that Jamie mentioned. So you'd expect me to say this, but definitely take advice in this space. So I was going to wrap up with a bit of an outro, but I think given we've got 1 minute left, I think we should probably try and get a couple of questions in. And so I'm going to go to one, a fairly straightforward one to begin with, that's come in from somebody on the webinar to say, the £2.5 million cap, which is transferred to a surviving spouse, is this still available if wife or husband died a number of years ago and prior to the change in these rules? So Zoe, Jamie, do one of you want to pick that up?
Sure, I'm happy to do that. And in short, yes, you should be able to you would assume effectively it was available, so you should be able to get that one.
Thank you, Zoe. Fairly straightforward one. Maybe a slightly more tricky one now, if I can, which is what are the options to consider ahead of a company exit to protect value for partner and children over time? Jamie, do you want to take that one?
Yeah, I should have taken the
Looks
first
like
one. Should
Zoe's
have
put
taken,
herself back on mute.
should have taken the easier one. So I think it just goes back to a lot of the things that we've talked about today. Where ultimately where do you want the proceeds to end up? Is obviously a key strategy. So, do you want those falling into your estate? Do you want those going into trust? Pre the rules changing, we often talk about transferring shares into trust pre-sale and banking some sort of significant gifts into trust. That is still a strategy now, albeit we are restricted to that £2.5 million. So I think it just goes back to a lot of the things that we've talked about today. We're going to be converting quite often an asset that is efficient from inheritance tax purposes with business relief to a non-efficient asset, so cash or debt. So just being sort of cognizant of what is your inheritance tax position going to look like, and where do you want those proceeds to end up? So again, just having those conversations as soon as possible, and not leaving it till the last minute, which I appreciate is quite often difficult when selling a business.
Thank you, Jamie. And I think that probably brings us to a close with slightly fewer questions answered than we'd hoped, but hopefully the focus on the content and the technical detail was helpful. What we will commit to is if you've submitted a question online, if it's not anonymous, then we will come back to you. If it is anonymous, please de-anonymize yourself and contact us directly with the question, and we will come back to you. For those that submitted questions beforehand, we will be in touch with some detail and perfectly on cue. There's our details if you want to beat us to it and get in touch. So thank you again for attending today. This was the second webinar in our Family Matters campaign. We will now move on to wider inheritance tax considerations before coming on to the hot topic of pensions in the autumn. So we look forward to seeing you then. And as I said at the beginning, the recording will come round shortly to all attendees. So thanks and have a